G'day guys, and welcome to this business management lesson. In today's lesson, we're looking at key knowledge point 134. That is Unit 1, Area of Study 3, and the fourth key knowledge point for this area of study. Today specifically, we're looking at economic conditions, such as, and hopefully this key knowledge point gives us a list, interest rates, employment levels, tax rates, and levels of consumer confidence. This is the third of 6 key knowledge points from this area of study that deals specifically with factors from the macro environment that affect business planning. And I'll remind you that the macro environment is defined as being the business environment in which you have almost no control, if any control whatsoever, over the things that go on. And the things that go on there, the factors there, the stakeholders involved in the macro environment have an indirect impact on your business. So we're not talking about employees or customers because they'll have a direct impact on your business. This indirect impact and indirect interactions with your business are what helped us to define the macro environment. Now, as far as economic conditions are concerned, we're generally talking about things that influence the amount of money people have and the flow of money through the economy. When an economy is good, it's said, or rather, we define an economy as being good or healthy or strong when individuals impacted by that economy have money to spend. So we're looking for things like high rates of employment, so that lots of people have jobs where they're earning incomes. That income gives people money to spend at different businesses. So if more people have jobs and more people are making money, there'll be more customers around. The more customers there are, the more customers you can expect for your own business, etc., etc. It tends to flow on like that. That's a strong economy. A weak economy is the exact opposite. Unemployment might go up, which means there are fewer people making money, which means that there's fewer people to spend money at your business and other businesses. There were fewer customers. Businesses start to do more poorly, which means that they don't need as many employees. They only need fewer employees if there are fewer customers coming through the door. Once again, it's a bit of a self-fulfilling prophecy. So the first thing we're looking at today is employment rates. And I've sort of just alluded to how employment rates impact the economy and are used as a measure of economic strength at any one time. Because, like I said, the more people who are employed, the more people who are earning a salary, then the more customers you can expect to have for your business. Now, employment is a bit of an interesting statistic. The Bureau of Statistics, which is Australia's main government body for collecting data on the population, defines people as employed if they work for at least 1 hour a week. Now, you and I probably can both tell straight away that 1 hour a week is not enough work to generate a livable income. Someone who is only working 1 hour a week probably barely has enough money to pay any of their bills, if at all, and certainly is unlikely to be a very lucrative customer for many businesses. So we do have to take the employment rate with a grain of salt. There is an economic term called underemployed, which would describe people in that sort of situation, working 1 to 10 hours a week, not earning a great deal of money, unlikely to be able to support themselves or a family with that level of income. And so the variates between the employed statistic and the sufficiently employed statistic is something worth looking at if you are a business manager and you're concerned about the strength of the economy. However, generally speaking, the levels of employment versus unemployment are a good metric to look at to determine the strength of an economy because, once again, the more people who are employed, the more people who are deriving an income, the more customers there will be for every business. Now, we can also look at interest rates. Interest rates are always expressed as a percentage, and it is the rate at which savings increase and debt grows. In Australia, the Reserve Bank, or the Reserve Bank of Australia, the RBA, sets the national interest rate, which is generally referred to as the cash rate. You might have, if you pay attention to news, noticed lots of reporting around the cash rate and the actions taken by the Reserve Bank in recent months. Certainly, when an economy is strong and businesses are doing very well, interest rates will have to be set high to try and balance higher levels of spending in the economy. And certainly when the economy is doing poorly, one of the things the RBA, the Reserve Bank, can do to try and preserve household incomes is to drop the cash rate, the national interest rate, to try and stimulate people's spending, and particularly to make it easier for people to afford to take on debt to handle costs of living during times of economic downturn. If we look at the cash rate for Australia over the past few years, we can see that in 2013, thereabouts, 2012, the cash rate was higher than it has been over the last 5 years, certainly heading into the COVID era where people were kept home. Certainly lots of people in hospitality and other related industries couldn't work. So household incomes went down. The economy took a bit of a downturn, a bit of a nosedive, and the Reserve Bank dropped interest rates to help manage that process. And then certainly if we look at the more modern, more recent data coming out of that period, you can see that the interest rate has rapidly and steadily risen to try and help the economy handle the release from the COVID era and the increase in spending that has occurred as a result. We can look at consumer confidence as both something that will impact the economy and it is used as a measure of the economy. Specifically for consumer confidence, more than these other things, it really is more of a measure than a factor that will affect the economy. But generally speaking, the conference board, I think that's supposed to say confidence board, will get together periodically and use all sorts of data points from research and studies to set what they determine, or what is called the Consumer Confidence Index. And consumer confidence is, generally speaking, a measurement of how optimistic individuals within perhaps your target market or within the community are feeling about their personal finances in the near future. So if unemployment is rising, if perhaps interest rates are high and people are struggling with the cost of living, you might expect consumer confidence to be declining, or in periods where employment is increasing and interest rates are affordable and people are feeling flush with cash and able to afford the cost of living, then you would expect consumer confidence to be rising in response. And remember, the more money people have to spend, or at least the more optimistic people feel about their finances, the more prepared they'll be to spend money, and that will stimulate the whole economy through providing more customers for businesses. Those businesses will require increased workforce and employees to manage that increased demand, and that cycle will help feed the economy. And tax rates. Well, these are the tax rates for the 2022 to 2023 financial year. They haven't changed from the 2021 to 2022 financial year, and it's always worth keeping an eye on them year on year because they can change, but sometimes they don't. Well, you can see here on this table that if you're an Australian resident who earned income in Australia in the financial year between 2022 and 2023, that you will have paid no tax on the first $18,200 that you earned. Whether you earned less than that, whether you earned exactly $18,200, or whether you earned more than that, your first $18,200 of personal income are not taxed at all. And then, if you know how to read a table, individuals will pay 19 cents on each dollar over $18,200 up to $45,000. Then, if you earned more than $45,000, you'll pay a further 32.5 cents on each dollar over $45,000 up to $120,000, and so on. So at tax time, if the tax department has collected this amount from you, then you won't owe them any money and you won't get a tax return. If they've collected less than the amount that you owe them at tax time, then they'll send you a bill for whatever you owe them. And if they've collected more from you than you actually end up owing, that's when you're eligible for a tax return. But that's how tax rates work. And generally speaking, the more people are taxed, the less money they will have left over. So you can expect that in an economy with very high tax rates, individuals probably don't have as much money left over at the end. However, the interesting thing about that is tax rates tend to go up when the economy is doing very well. So looking at the rates at which people are taxed and where these thresholds are, how much you have to earn to get moved between different tax brackets, will give you an indication about the strength of the economy. If people are paying less tax, or if that tax-free threshold is increased, it's probably an indicator that the economy isn't doing very well. And if people are being taxed more, it's probably an indicator that citizens can afford to be taxed that much because the economy is doing very well. So finally, and in summary for this key knowledge point, when an economy is strong, there are more potential customers because people have more money. That's what it means to say an economy is strong. When people have more money, they're more likely to spend it at businesses, including your business. So as a business manager, we like to be on the lookout for the markers that indicate a strong economic performance. The measure of how likely someone is to buy something is called consumer confidence, and that's important to remember. It's also important to note, although it has been removed from the study design as of 2023, that the degree of optimism that business managers have about their economic conditions is called business confidence. And I only raise this because it's possible that if you're looking at an older textbook or older resources for business management, you might find that term still cropping up. So it's worth you knowing about it. But generally speaking, under poorer economic conditions, there will be fewer customers and businesses will struggle. Under better economic conditions, there will be more customers and businesses will do better. It's a pretty simple sort of concept, the good old economy. But generally speaking, if you're a business manager, you want to be making decisions in planning based on whether or not you can predict that the economy is doing well or doing poorly. If the economy is doing well, you might need to recruit more staff. You might be looking to grow your business. If the economy is doing poorly, you might want to conserve income. You might not want to be spending significantly at that time. It might not be a good time to be recruiting new employees. You might want to, in fact, try and save as much money by cutting wages as possible. So you might look to make some redundancies at a period like that. Whatever you do, pay attention to what the economy is doing because it will have an impact on your business, although it's indirect through whether or not customers have money. That's all for today. See you next time.